Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and anyone who's been following the markets this week will obviously be aware or will have something to say about NVIDIA and AI, but I'll get to them a little bit later. I wanted to start by talking about a company called Adyen. Now, for those that don't know about Adyen, Adyen is a Dutch payment company that act as a payment platform and a payment gateway, which means they're essentially they leverage technology that merchants can use to accept credit card and debit card payments. Their entire USP, their entire proposition is that it's an all-in-one solution for merchants. It's a one-stop shop for merchants to initiate payment through, a wide range of methods. As I mentioned, credit card, debit card payments, risk management and fraud protection, which is part of their offering, payment processing, which is essentially the connection between the customer's bank and the merchant, and obviously the payment settlement. Now, Adyen competes with a company called Stripe, which may be much more of a well-known competitor, as well as PayPal in the payment space. And some of Adyen's customers are very high-profile names such as Meta, Netflix, and Spotify. So what happened was last week, shares of Adyen plummeted nearly 40% in a day, losing $20 billion in market cap, and that's in a single day. This was after it reported its slowest revenue growth on record. Now, why exactly did it drop? I mean, obviously, Adyen reported their results for H1. Revenue was up 21% year over year, but fell well short of estimates of 40%. Now, since going public in 2018, or since being listed on the Amsterdam Stock Exchange, Adyen have consistently reported a 26% growth every half year since 2018. And it's obviously very much looked at as a growth stock. It is a growth stock. The CFO mentioned that, due to macroeconomic situations, Adyen now are more focused on the bottom line and profitability versus their growth. Inflation is high, interest rates are high, the cost of borrowing is high. So, growth may be expensive for a company, which may explain the decision and strategy that they're going for. But investors did not react well to this at all. Tandowski also reassured everyone, Tandowski, who's the CFO, also reassured everyone that, they hadn't lost any major customer. None of the big customers of theirs had walked away. But I guess concerns in investors' minds is revolving around competition in North America, as competitors in that region are cheaper. They may take market share from Adyen. Consumers are probably wary about their spending, and I think it's a valid concern to have. Adyen's EBITDA margin fell from 59% to 43%, and this was due to softer growth in North America, coupled with high costs. So obviously they've hired a bunch of people, and because of inflation, they've had to increase wages. Now, in terms of how Adyen sort of position themselves, a company could take, one of two approaches. Now, that's either a cost leadership approach or a product differentiation approach. Adyen seem like they're aiming for the latter, with a focus specifically on functionality of their product. And I think because they're going with that product differentiation or their premium approach, they're having a hard time showing why they warrant that premium. Customers are a lot more stringent now than they have been before. And this is due to, obviously, the macroeconomic environment, high interest rates and inflation. Customers don't want to spend. So I think it's really about how Adyen leverage their functionality and whether they can make customers believe that the premium that they're paying is worth it and whether they're gaining something out of it. And, while a bunch of competitors like Stripe were laying off employees, Adyen hired 551 people in the first half of 2023. Now, I know Stripe obviously have a much larger employee number count, but I don't know if hiring this many people was the right move in investors' eyes. I don't know if the sell-off is warranted, to be honest. Like 20 billion drop in a huge day is massive. It's huge. And of course, with a growth stock, the most important thing you want to see is top line growth. Everyone's focused on revenue and how fast revenue is growing. But at the same time, everyone is facing these macro headwinds, and despite these headwinds, they grew 21%. It just wasn't as high as expected. It is tough. It is tough, but I do believe going forward to compete more aggressively, Adyen are going to have to compromise on their margins. They may have to lower their price at least a bit to not lose too much market share. But I will say if they can successfully differentiate their product in terms of functionality and complexity, then, perhaps they will be able to sustain more of a premium. And we really have to, me particularly, have to really dig deep into what pain points Adyen's added functionality compared to some of its competitors is addressing. Because if we come to the consensus that, these pain points are not really that big, they're not that pressing, and companies aren't so focused on solving these pain points, then Adyen's added functionality does not make much sense. I want to also talk about a company called Grab. Now, Grab is the Southeast Asian super app, as many of you would know. I guess think of Uber, but with more functionality. They have 4 segments. Now, they have their delivery segment, their mobility segment, their financial services segment, and their enterprise and new initiatives division as well. So with Grab reported earnings on Wednesday, and wow, what a result. Shares didn't pop too much, but let's look at what they reported. I would say after Uber reaching profitability earlier this year, all eyes have been on Grab to follow that roadmap and ultimately reach that status. I think the expectation is just that now that Uber has done it and proven that it's possible for a ride-hailing app to do so, all eyes are on companies like Grab. And Grab, being the biggest in the region, obviously would be under the most scrutiny. So what did Grab report? Well, they reported that losses fell 74% year over year and revenue was up 77% year over year. And this was due to growth across all business segments. That's incredible. Improvement in bottom line was attributed to lower group adjusted EBITDA losses. Now that came in at negative 20 million versus negative 233 million last year. So the 92% narrowing of the group adjusted EBITDA loss means that their guidance for break even in this metric was brought forward to Q3 from Q4 this year. Revenue was up. More people are using Grab now than ever before. They reported the highest amount of monthly transacting users, and along with that, costs were down. Now, why were costs down? Well, staff costs were down 6% due to layoffs. They conducted a big round of layoffs, I think, earlier this year. Variable costs were down due to an increased operational efficiency within the company. Now, their guidance for revenue is unchanged, remaining at between a 54 to 60% year-over-year growth. I'm not sure whether that's to manage expectations, but I'm a little surprised that it's unchanged. To get into the depths of how their segments did, their delivery segment revenue grew 118% year over year, with their subscription program showing strength. Their mobility segment revenue rose 29% year over year. Their financial services segment, which grew the most, grew by 223% year over year, and this was because of improved monetization of the business and higher contributions from lending. Their enterprise and new initiatives division, which includes advertising, Grab advertising, also showed growth in revenue of 95% year over year. So overall, a very, very strong quarter from Grab. I'm surprised that their shares didn't react more than they actually did, but I believe at one point they popped maybe about 10%. Now, another big tech company that announced earnings this week was Zoom. with Zoom, the stock's been a bit up and down this week. If you look at it, it popped up on Monday after CEO Eric Yuan spoke a bit about Zoom's AI tools and their roadmap and plan of action. This was also after he stated that he expects a stronger than previously expected earnings for the rest of this year. And you, of course, also have Zoom announce their earnings on Monday after market close, which caused the stock to subsequently drop 6% on Tuesday morning when it opened. Now, if we look at the results, honestly, they weren't all that bad. I mean, revenue came in above what was estimated, came in at 1.14 billion versus 1.11 billion. Adjusted earnings per share came in at 1.34 versus 1.05. Now that's a big beat. Free cash flow was higher than estimated, 289.4 million versus 258.6 million. Their number of enterprise customers slightly lower than estimated, but it's trending in the right direction. It came in at 218,000 versus what was estimated at 219,350. Now their Q3 revenue forecast was pretty much spot on. Came in at 1.12 billion versus 1.12 billion, which was estimated. And I think that's where the disappointment was. Enterprise business, as we can see, is doing pretty well. The customer count looks good. I think it's heading in the right direction, maybe slightly short of what was estimated. But yeah, overall, it's going in the right direction. And while the company's overall forecast for the year was higher, their third quarter forecast remained the same. And I think that was the disappointment. That was sort of the masking. And that's what caused the 6% drop, because analysts were like, why? You've raised guidance for the rest of the year. Why not for Q3? And I do believe Zoom's justification was that, the business is seasonal. And I get it. It makes sense. Holidays occur in certain seasons, certain months, certain quarters, and that could affect profitability of the company, revenue of the company. But I still think that's what was disappointing for analysts to see and investors to see. Now, one thing I will say about Zoom is how easy to use the platform is. It's amazing for users. As a product, I think there's very little someone can say that's wrong with Zoom or that's bad with Zoom. And, I think they know that. And I think that's what's keeping customers for them. But the other thing about Zoom that's more interesting was their AI play and how that's going to be their focus going forward. And I think that's a great outlook. They have a new CTO who was previously with Microsoft Azure. So proven leadership, someone who's done it at a big company previously. They don't use customer data to train their AI models, which is something they have made clear recently, and I think that's great. And Zoom IQ. I want to talk a bit about Zoom IQ because I think this can lead to more sticky customers, a more valuable experience, can improve operational efficiency of companies themselves when having meetings. I mean, what Zoom IQ is a service that leverages generative AI in order to take minutes of meetings. So when you're having a meeting, instead of having someone type up minutes or type up a summary, Zoom IQ will do that for you based on what is being discussed in the meeting. And I think that's an incredible move in the right direction. I think products like that, if Zoom can be creative, if Zoom can constantly come up with innovations such as this and leverage AI and technology the right way, they can really improve efficiency of a company. And I think that would really help boost the enterprise business even more. Now, I wanted to close on the final topic of the day, and that's obviously the biggest one of the week, NVIDIA, I will say, is truly the stock of the year. I'm just so upset and bummed that I don't own it. And I remember last quarter when I spoke about NVIDIA, I said I believe it's overvalued. And my God, that looks like a joke now. I mean, at that point, I think it had just broken through that 400 barrier. In the last week, it's gone up from 420 odd US dollars to above 500 at one point. And it's just been the growth story of the year. I mean, the stock has nearly tripled, I think, this year, and once again this quarter they smashed expectations with earnings, which is so hard to do given the sky high expectations from this company. Now, the revenue came in at $13.5 billion versus $11.2 billion that was estimated. That is a massive beat. EPS was $2.70 versus $2.14, which was expected, a 26% beat. And they also announced a buyback of $25 billion worth of stock. So NVIDIA believe in themselves even more than the market believes in them, which is hard to fathom because at the moment NVIDIA is the market's darling child. If we look at, just the landscape as a whole, NVIDIA chips power nearly all of the major AI apps across the world, including ChatGPT. Now, demand for such chips is so high that it might have actually exceeded supply for NVIDIA, and NVIDIA might be having trouble supplying to everyone that's demanding their chips. Competitors of NVIDIA were falling in the red following their results, namely AMD, which was down 8%, and you can see why. You can see NVIDIA just dominating this industry so much right now. But I will say, on a wider scale, the industry is too big to have only one winner. And I do think in due time the others will rise. But right now, it's all NVIDIA who dominate this AI market. I do own shares of AMD, and I am hopeful that a lot of these companies will rise up to the challenge. Obviously the US and China geopolitical situation is a concern for anyone in the chip industry, whether you're an investor, an outsider, a procurer, or a supplier. And everyone is hopeful that this situation won't escalate, and actually hopeful that it would de-escalate so that companies like Qualcomm, Intel, AMD, and NVIDIA themselves too can all benefit. NVIDIA has mentioned that if there are more curbs, that would be painful, and that could mean permanent loss for the company. So I think everyone's hopeful that this doesn't escalate too much, and that they can come to some sort of amicable consensus as to how the chip industry can function in both regions, and how companies are able to supply to both regions. But overall, I'm just truly shocked at NVIDIA's earnings, and it's probably a massive surprise, maybe the biggest surprise of this earnings, because I think the trend we've seen in this earnings season is that a lot of companies were overvalued based on AI, and it was humbling, right? You saw a lot of shares drop based on updated metrics, updated revenue, updated guidance, and for a lot of companies, it's like, okay, growth is not going to be as fast as maybe we first imagined when this whole AI hype broke out. But for NVIDIA, it's the other story, and I just think it is so incredible that they have managed to beat estimates yet again when they are arguably the highest they've ever been. And highest they've ever been as in expectations are the highest they've ever been. So I guess that wraps up this episode. If you all made it this far, and if you enjoyed, I thank you for listening. Once again, I'm Anurag Birla, and this is the Finance Now podcast.